How's life?
Yeah, good. It's supposed to be a scorcher here today. We've had a
Mm,
very calm, comfortable summer, but summer has finally arrived.
summer's arrived. Ours is ending.
Yeah, there you go.
Yeah.
Well, that's good.
No, it's not good.
Oh,
We're creeping into snow.
oh, well, our weather is quite different these days, right? Everything's off kilter just a little bit.
I know it is. It's true. I need to
Yeah.
put my phone on silent here. How's everybody's market? Is it like picking up finally? No? Actually, Stephen, I talked to Bev the other day because you're like a second home market, huh?
We're such a strong second home market. Yeah, it's pretty crazy here right now.
Oh, you're in
Uh,
Flagstaff. I just saw that. I'm in Prescott, so I'm close to you.
Oh, sweet. Right on.
I just moved here not that long ago.
Very cool.
Heather, I don't know if you saw it, but I don't. Do you all ever pay attention to something called Resi Club? I don't know if you guys see. It's another statistical thing, but Louisville and Salt Lake City were both one of five of the top 50 real estate markets that actually showed improvement between 24 and 25 over 23 and 2024. So we were getting stronger versus getting weaker. So Salt
yeah,
Lake and Louisville are two of the stronger markets out there.
happy to be in Salt Lake. I can tell you that right now. Yeah. And
I feel
it's
like your market doesn't like follow all the time the national trends. Like you guys, so many people have moved to Salt Lake over the last 5 years.
it's crazy. Yeah. What's up with Louisville though? Like why do you feel like that's happening in your area?
Uh, I think there's a couple reasons. I think, we don't go crazy. So like we never went crazy. I mean, we did go crazy high for us, but not according to everyone else. And people just still make pretty sound financial decisions here. And affordability is still not terrible. I mean,
Mm,
it's not nearly what it was, but it's still pretty good. And then and I think we're getting some Nashville overflow. Like I think that
mm.
people go to Nashville expecting it to be cheaper, and it's really not anymore. And we're 2.5 hours away, and then they get up here and they're kind of pleasantly surprised by what Louisville brings. So, um, yeah. Nicole set me up with somebody recently that had someone move in my area, so I'm going to help them in the wintertime. So,
Yay.
thanks,
That's
Nicole.
awesome.
Sure.
Awesome. Awesome. I've never been out your neck of the woods, so
Now, I know
Nashville's
I've
it's
come to
not your
see,
way.
I've visited you. I've seen you at least 4 times, 3 times.
I know.
You haven't come to see me yet.
Salt Lake's a little more of a destination than Louisville, Kentucky.
I would debate that.
Hey, Louisville's got the Bourbon Trail, baby. You got to do the
Lots of
Bourbon
good
Trail.
stuff.
Oh, you
The
got to
food
do a
and
Kentucky Derby once. I mean,
yes,
it,
there
it
you go.
is an
Yeah.
amazing event. If you go one time, it's fabulous.
Yes.
Invite me
Have you
next
been, Nicole?
time.
Yeah, I went over a decade ago. My friend grew up over there, and so of course it was one of the times where it was like super rainy. But the sun just lifted. But no, it was fantastic, and I love seeing everybody getting on the plane with their hat boxes.
Mm-hmm.
I mean, that was
Yeah.
the only stuff going in the overhead compartments were the hat boxes. But no, it's a fantastic experience. It
Yeah.
really is just terrific. So yeah.
Believe it or not, we've already started I've been in meetings for the last 6 weeks already planning next year's Derby season. So we're already doing it. So
There
Because
you
you do
go.
the announcing, right? You're the radio guy.
I did some radio for it, but I'm going to be the chair of this board here in 2030, but I'm on the executive board of an organization that puts on 70 events with a $225 million economic impact that surround the Derby. So we do like a 3-week party leading up to this 2-minute horse race.
Sweet.
Yeah.
Sounds like fun. All right. Well, we have a small little group here today, and I don't even know if I need to introduce myself because I know you all personally very, very well. But I am going to introduce Michael King. Michael, thank you for coming on and sharing your knowledge about commercial with us. I'm excited to hear and I'm going to record this. I'm sorry. Because if I don't do this now, then I will not do. Oh, I am recording. I didn't do that though. Stop recording. Okay, it's recording. But anyhow, Michael King is a dear friend of mine. He also happens to be the fiance of my marketing coordinator, Brooke. So we love Michael. Michael, I'm going to just give him an introduction. So he's the senior director of Cushman and Wakefield here out in Salt Lake City, Utah. And he co-leads the capital markets and investment sales for the entire state of Utah. And he is very successful and very smart. And you went to college as well. And like, tell us a little bit about that and a little bit about you, and then I'll let you get rolling.
Yeah, sure. So a little bit of background on me from Cincinnati, Ohio originally. So I've been on the Bourbon Trail. I know the Kentucky Derby, so kind of neighbors to you, Mike. But yeah, I came out to Salt Lake about 8 years ago. The reason I came out here is I wanted to be in a small, high growth commercial real estate market in the West, and Salt Lake checked every single one of those boxes. I did go to school for commercial real estate and finance from the University of Cincinnati. That being said, I will tell you that majority of people in commercial real estate that I work with right now, they didn't go to school for it, right? They came and got into it, fell into it, whether it be family or just passion about it, and kind of just figured it out. And there's a lot of that still. There's not an easy path into commercial real estate. There's not, a lot of training you can do or programs that you can go through to really get your experience up. It's just all getting in with the right people, getting your hands dirty, rolling up the sleeves and trying to figure it out. It's definitely a unique business in that regard.
Awesome. Cool. Well, let's hear what you have to share with us. I'm excited to learn.
Perfect. And yeah, I want to keep this conversational, right? I think if you guys have questions or you want to dig deeper on any of these topics, please interrupt me, jump in. I think it's more beneficial, more fun for everybody if we kind of get a discussion going here. But really, what we put together today that I think and hopefully you guys would find value in is kind of talking about the differences and the fundamentals of commercial real estate as it relates to residential and the similarities. Talking about what's important to investors and how do investors think, right? Talking about how do you value commercial real estate on a very high level. And then, going into where do I see, if I were in your shoes, right, in a residential agent or broker that wanted to break into commercial real estate, where do I see opportunities for you all to do that, right? And kind of keep your eye out for deals and opportunities that you can add value on. So that's kind of the agenda here. And like I said, please jump in with questions and let's have a conversation about all of this. To kick us off, I want to just talk kind of the big picture of, what's the difference between commercial real estate and residential. And I want to start by saying that I actually think that it would be easier and a smoother transition for residential agents to come into commercial than it would be for a commercial agent or broker to do residential. I could never do what you guys do. We actually just bought a house a year ago. We used Heather and Cassie and the team to do it. And I think there's this sentiment that, oh, like commercial brokers just think they can be residential brokers or vice versa. But what you guys deal with and the emotion and dealing with just a lot of for lack of a better term, maybe unsophisticated home buyers, right? That takes a ton of patience and being on and working weekends and all of that. I mean, we are cut from different cloths, and I actually do believe that it'd be easier for residential to break into commercial than vice versa. I could not do what you guys do by any stretch of the imagination. But let's dive in here. So some of the differences and really the major differences between commercial and residential are one, obviously the deal size, right? Bigger dollar amounts on commercial. And that translates into just much longer transaction timelines, right? When you guys are selling homes, 30-day due diligence, 30-day close. When you're dealing with 20, 50, $100 million at risk, there's an extraordinary level of due diligence that goes into that. And each asset class is a bit different, but I think naturally when you're thinking about investing or putting that much money into one asset, you're gonna make sure that you've got all your I's dotted and your T's crossed, right? And so much longer timelines. Our average deal timeline back peak of the market, 2021, when everything was on fire, both residential and commercial, we could get deals done in that 30-30 timeline. I will tell you right now, with the economy, all the political uncertainty, and with trade and geopolitical kind of uncertainty, as well as interest rates and everything else we're dealing with, those deal timelines have blown out recently to, on average, 120 to 180 days all in, right? So I think a big difference is, you get it's much longer from when you put a deal under contract to when you could get that commission check. Number two is the valuation drivers, right? And residential, I think it's very comparable driven, very neighborhood driven, and commercial, right? It's all about the income. The one similarity that we do have is location, 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 and I've got an example to kind of show that, later on here. But I think it really stems from, you're selling an income stream, right? Almost a small business, instead of looking at what other properties in the same neighborhood sold for, because the income, that your neighbor's getting might be different from what you're getting from a commercial perspective. Client motivation, I think, in residential, it's more that lifestyle and the emotion, and selling that dream of home ownership, and where you want to raise your family, and schools, and all those things. In commercial real estate, it all comes down to the returns, right? It's used for tax efficiencies and hedges, inflation hedges, and all about the cash flow. I think one thing that I think is underestimated and a lot of people don't know is the relationship aspect of commercial real estate. We talked about the bigger dollar amounts, right? And so the trust level that you need to have with a client in order to get that business, when you're talking 10, 20, 30, 40, 50 million dollars, that takes much, much longer. On average, I would say in my career, I start a relationship. It takes me on average over a year before I see any business from that client. And that is constant reach out. My mindset that I have is offer everything that you have and ask for nothing in return. And that leads to business, but it's really challenging with the deal timelines, how long it takes to prospect, to break into this business. And that's why you don't see a lot of people try to get into commercial real estate, because it is such a steep learning curve, and it takes so much longer before you start to see deals. I talk to young people coming out of college all the time, multiple times a week, and they all want to be a commercial real estate broker, right? And I think they have this idea that you just, you point at a building, it sells, you get a big commission check. But the first thing out of my mouth when I'm talking to these younger folks wanting to get into the business is, are you okay not making any money for 2 years, right? And the reactions I get is hilarious, because they're like, "Well, what do you mean? I'm a college graduate. I have a degree. I have student loans. I can't not make money for 2 years." Okay, well, I think we need to evaluate if brokerage is right for you, or find you a different path in, right? Because the reality is that most brokers do not see their first paycheck until about 18 to 24 months in the business, right? And so I think that's still similar to residential. But I think that working with buyers and doing some other things, you can get there a little bit quicker. Takes a lot longer to build those relationships. And then I think the last point to mention is the overhead, right? And that's a huge difference. In order to compete in commercial real estate as a broker on an institutional level, meaning those bigger dollar amounts, you have significant overhead, right? The biggest investors in the country want to know you have your own designated marketing. You have your own analysts. You've got multiple assistants, junior brokers. Our team, we're a 7-person team, and the overhead to me and my partner is over $500,000 a year just in salaries, right? And that's before bonuses. And I think that's very much underestimated from first-time brokers trying to get into the business. Any questions on some of the differences, comments, anything else you guys want to discuss here? Cool. Keep it moving. So let's talk about some of the core asset types. I like to think of these as the food groups of commercial real estate, and there's really 6 different asset classes under the commercial real estate umbrella. The first one is multifamily, and it's what I think a lot of us on this call are going to know. So big apartment buildings, duplexes, triplexes, 5-unit deals, all fall under that multifamily umbrella. Obviously, we've got office, that can be high rise, big downtown office buildings. That can be suburban office, like Heather's office, right? In Draper, where it's kind of cool, interesting retail flex office space, which is actually doing extremely well today relative to the big corporate towers. Industrial, I love industrial. Industrial is a very hot asset class right now. We joke that we don't need front doors anymore, right? We should just put in a loading dock for all of our Amazon packages and call it a day. Industrial is an asset class that I see growing and expanding significantly over the coming decades. And really probably over the next 100 years, with warehouse and logistics, last mile shipping, cold storage, manufacturing, all of those things fall under the industrial umbrella. Retail's having its day back in vogue right now. Obviously, we all know retail, and during COVID, we thought we'd never shop at a brick and mortar store ever again. What we're seeing actually in the market right now is retail has right sized. It's become an attractive asset class, and it's not so much the big national brands anymore, right? The J.C. Penney's, the Nordstroms, the Kohl's, all of those things. The irony of retail right now is investors want the local credit because that's their livelihood. If it's a mom and pop retail store, they know, hey, they're not just going to go into bankruptcy, close the doors, and call it a day. This is the livelihood. And so that mindset shift has really spurred a big push into retail. Hospitality, really fun one, especially here in Salt Lake, where we've got, Park City and all these big resorts, St. Regis, Montage, all of those. We get to work with a lot of those big luxury hospitality operators. I think hospitality as an asset class is a good one, but also can be fairly risky because it is dependent upon spending, consumer sentiment, travel, all of those things. And then naturally we have land, right? And land is also an interesting one as it relates to the value of land and how you can get there. And so, just we kind of talked about this, but I kind of talk about how each one of these are different and how investors look at each one of these asset classes. Multifamily is the closest to residential, right? And it's valued based on income. The reason that investors right now, and we hear and read about it all the time, love multifamily is for a couple different reasons. One, there's a lot of markets. I was listening to you guys talk about, your markets. There's a lot of markets, majority of markets, right, that have these high barriers of entry for first-time home buyers, right? In Salt Lake, it's extremely difficult for first-time home buyers to buy into a market with median. I mean, Heather, you tell me, what are median home values in Utah right now?
They are almost 600. So I think the last report was like in the 580. So that's the median sales price here. So very expensive. I mean,
Very
to
expensive.
get a
And our
condo.
median incomes, right, are probably less than 100 grand. And so when you look at that, a lot of investors across the country are saying for sites or for markets like Salt Lake, multifamily is going to be a big 10-year plus driver because of, the inability to buy, single family homes. And so it's a longer term appreciation and cash flow with multifamily. Office, on the other hand, is I think driven by, lease terms, the tenant and the credit tenancy. So for example, if you had a headquarter location for Apple, right? Investors are going to pay a higher price for that than if you had, more like a local or regional, single tenant office that, they're not publicly traded. They haven't been in business for a long time, right? So a lot of office is driven by the tenancy that's in place, not so much about the real estate itself. And then additionally, the market demand for workspace, right? What jobs are coming in here? What kind of jobs? Are they tech jobs? And if they're tech jobs, are they HR and finance and sales, or are they coders, right? And who's more valuable, and how is that going to impact my ability to lease my office? Industrial, we kind of talked about it, but warehouses, logistics, manufacturing space, very, very strong demand from e-commerce right now since COVID. That has absolutely exploded. These leases also come in, they're longer term leases, typically with credit tenants. The market views industrial as very low risk right now. On the retail side, right? Tenant mix and location are everything, right? You wouldn't pay the same price for retail on Main Street in Park City as you would in West Valley City in Utah, right? Which, West Valley is going to be lower demographic. Park City's the highest demographic area in the state. I think that strong national anchors are stability, but the shift, as we mentioned, that we're seeing right now is the shift to more local mom and pop operators, which is great for retail in the long term, right? Because I think we all, being residential agents, commercial agents, right? We all work 100% commission. We take a lot of risk. And me personally, I like supporting local businesses, right? And I think that that's great for the economy overall. Hospitality operates very much like a business, right? If you were to go and value and sell, an operating business, a landscaping business, something like that, hospitality is valued very much the same. Very heavy payroll. Think about the kitchens, the staff, the cleaning, everything that goes into that, right? And I think that, hospitality is very dependent upon consumer sentiment, seasonality, draw to location, all of those things. I really like hospitality, but in my opinion, it's one of the more risky asset classes that has dramatic overhead and is challenging a lot of the times outside of the big national brands to really cash flow. And then land, and in Salt Lake, I think in downtown Salt Lake, I've got a 75% market share in development land. And development land is extremely complicated and nuanced and, really difficult. And developers, I maintain, you hear in the news, everybody's up in arms, like, hey, this developer is building a big project next to my house. We want to shut it down. You have all the community saying these developers are overpaid and they're charging too much in rent and all of those things. I see it every single day, and the amount of risk that developers take, given it's going to take, it can take 7 years. I'm doing a deal right now where it took them 7 years from acquiring the land to delivering the project due to entitlements and zoning and working with the city and, doing these building materials and instead of, these building materials they originally wanted to do, right? And you can start a project 5 years ago and it makes sense. And then you have what we're experiencing in the current economy with higher interest rates and less capital in the system right now. And all of a sudden, when you deliver that project, it doesn't work anymore, right? And so developers take on a tremendous amount of risk. And I think that's underestimated across just the public view of development as a whole. I'm going to pause there again. Any questions on any of these asset classes? Any of these interest you that you'd like to dig deeper in? Happy to answer anything and everything here.
Uh,
Okay.
Yeah.
So,
so go
hey,
ahead.
Michael.
Sorry.
Yeah, no, it's fine. So I've got a couple of people that I'm actually starting to work with that are really going more into the senior care facilities. And I know that's growing. That's really where the
Absolutely.
huge wave is of people looking for, I mean, obviously as Brian, Buffini keeps telling us, we're entering the silver tsunami. And so I've got quite a few people that are getting into that space. I'm going to meet some people over the weekend that are already doing a lot of stuff with doctors and whatnot, and building these type of properties, and the income on them is huge. Whether it's, sober, but the senior care stuff is massive. So are you seeing a lot of that as well over there? Because in California, it's massive.
Absolutely. Nationally, we are seeing it. We call this the push to the alternative asset classes, right? Because it's kind of quasi multifamily and hospitality mixed together. And so when we have assets like senior housing or low income housing tax credit deals, or something that's maybe quasi multi but also quasi hospitality, we call those alternative asset classes. There is a massive push. Utah is an anomaly in this regard. We're the youngest state in the country, but overall we have an aging population with a birth rate and household formations that have been dropping off a cliff for a number of years, right? Maybe decades. And so when you look at when people are having kids, if they're having kids, it's much older, right? And it went from 3 kids, now it's we're having 1 kid, and I think that marriages and all those things, right? So we do have that aging population. Some of the biggest investors in the country, the BlackRocks of the world, the State Streets, the Vanguards, all of them have created acquisition and development verticals around senior care facilities, and we anticipate that over the next 12 to 24 months, we're going to see yields and cap rates, which we'll talk about in a minute, compress on those asset classes given the demand for senior housing.
My question, real quick, unless Nicole has a follow-up. When it comes to the retail, with the emphasis on the mom and pop shop, does that mean the retail is becoming less anchor dependent?
It is. It is. That's a great observation. I had a deal where it was shadow anchored by Target. And believe it or not, Target's one of the more healthy national brands. Most of the groups said, hey, we just want what they're considering neighborhood unanchored strip, right? And that's where they see opportunity in these mom and pop kind of local credit deals where, like I said, it's their livelihood, right? And so we're actually seeing where 2 years ago, 3 years ago, it was don't show me any retail unless I can control the anchor tenant, to now this shift where you've got big groups like Nuveen, for example, one of the biggest REITs in the country, saying we are funneling hundreds of millions of dollars to local operators and local boots on the ground folks to go take down neighborhood unanchored strip with local credit, roll it up, and try to sell that as a big portfolio to another institution. So yes, absolutely, it's been that mindset shift, and it's really interesting phenomenon right now. Any other questions?
So of all of these asset classes, which ones are least complicated to do? I would think like industrial, but is that true?
Yeah, I think that's right. I think multifamily and industrial are the two, call it, most simple and easy to understand. From there, office is extremely complicated. I would say retail is similar to that. Hospitality is likely the most complicated, just given it's really a small business with a tremendous amount of overhead.
I do find it interesting though, like in the industrial side, because we have with UPS being here in Louisville, we have a lot of that goes on. Like it's not just the square footage that matters, like ceiling height, how many pallets you can stack up. Like you have to look at space completely differently than what you would do just as what we're used to as realtors, I guess, in
Yeah,
residential.
spot on. You're spot on. 5 years ago, your clear heights or your ceiling heights, right, were very typically 20, 22 feet. And now Amazon, which they've got a couple million square footers in the Salt Lake market, is saying we need 32 foot minimum clear height, significant amount of power as well, Mike. I mean, the power needed for manufacturing and for all of this equipment is tremendous, right? And so power and ceiling heights, fire suppression systems for inventory and insurance purposes, all of that, those are the biggest needle movers of value as it relates to industrial. So moving on, I think before getting into deal valuation on a high level, I think it's good to understand how commercial real estate investors truly think, right? Because I think that sets the baseline for why we do what we do, how we articulate value, and how we look at deals. Number one, it's return metrics, and the return metrics, and we'll go into these in more detail. But cap rate, internal rate of return, equity multiple, cash on cash, yield on cost. Those are the main drivers of value or excuse me, of how investors think, right? And what they're looking at when they're evaluating an investment. And it's different, right? It's different across the asset class, but it's also different across investors. Some investors might be more focused on cash return, right? They're going to look at it more like a bond, right? If I can go buy a 10-year treasury bond with a UST bill, it's going to pay me 4.25% or whatever it is right now, and that's the least risky, or historically has been the least risky investment that you can make in really the globe, right? The cash on cash groups look at it and say, I can go buy a bond for 4.25. I'm looking at cash on cash as my metric. So I want to get at least 6% for the risk that I'm taking on in commercial real estate for multifamily, for example, right? So that would be an example of a cash on cash return investor. IRR investors, IRR takes into account your exit price point. It takes into account, discount cash flows and the time that you're going to hold the asset, as well as your cash on cash returns and everything else, right? And so those investors are more focused on longer term horizon, thinking about how are we going to buy this, and then what's going to be our exit price point, whether that be, cap rate compression, driving the value, rent growth, doing a value add investment, meaning we buy a duplex that's in a great location, but it needs some work, it needs some updates. And if we do those updates, we can get, another $1,000 a month in rent, right? And then we're going to sell that. And that's going to allow us to sell for a higher dollar amount. Those are going to be IRR investors. Yield on cost is how we value development, right? Because development is all speculative, as we talked about. And so it's not so much about the cash flow, but it's about the perspective cash flow that you could potentially get, and what's that return relative to the total cost to build it, right? So the cost of the land, your hard costs, so your building materials and everything else, and your soft costs, your design, your architecture, that all in, your NOI divided by all of that cost gives you your yield on cost. And that's how developers will look at development sites and give it the green light or the red light, right? Risk versus reward. As investors look and underwrite opportunities, for example, more on the commercial side, they're going to really dive into the length of the lease term, right? The longer the lease term that we have in an office building, for example, right? Single tenant office, and the lease term is 10 years. Well, we know we've got 10 years of that cash flow coming in, guaranteed by a big corporation. And so that is worth a lot to us. We're willing to pay more for that income stream. If the tenant has credit, right? We talked about this. Apple, for example, are going to garner very low cap rates, very high price points if they're in any office building, relative to if we were to sell something that had a tenant in there without credit or wasn't publicly traded. Vacancy risk, right, is another one that they look at is, okay, when are the leases expiring in this building? How much vacancy is there? And then what's the cost, right, for me to backfill that vacancy? The downtime, how long is it going to take me to fill it? What's the tenant improvements that I'm going to need to pay in order to attract a tenant of the caliber that I want in my building there, right? I think there's so many different things that go into it, outside of just the comps, right? And I think every single commercial real estate deal, especially in today's market, is different, right? No deal is created equal and no investor is created equal, right? And so everybody's going to have different risk tolerance, different markets they want to target, different asset classes. These guys might not like office, so they're not going to be your buyer. In order to buy office, they would need a 15% return, where these guys are more bullish on office, and so they're willing to buy it at a 10% return, right? So there's a lot of nuances across the board. Separately, I think where it really differs from residential is the debt and the equity strategies. Very complicated, what we call capital stacks, right? There might be 3 different lenders involved at different points in a commercial real estate deal. For example, you have the senior lender, right, who did the original loan. Then they're going to go out and get some mezz financing because that senior loan or lender would only do 50% leverage, and we're trying to get to 70%. So then we're going to go and we're going to take on some mezz debt, right? And that's going to be priced differently and at a higher interest rate than the senior. And then on top of the mezz, you might have some preferred equity in there, right? Which is also going to be different. And so you can get through, I've seen some capital stacks that are, 10 different hurdles, right? And so if there was a foreclosure or some event, the kind of who gets paid off first and how that trickles through can get really complicated and really interesting. And then on the equity side as well, right? We do a lot of this where we source equity for our clients for deals, and that can come, in a bunch of different buckets, right? So very complicated capital stacks on how to put these kind of deals together. And then I think finally, the market selection. I like to say that investors can't control the macro, right? You can't time the market. You can't control what the Fed's going to do with interest rates. You can't control construction costs. You can't control if this tenant's going to leave this building, right? But what you can control are the markets you invest in. And the markets that investors are hyper focused on right now are high growth markets, a lot of secondary markets, right? Like Salt Lake and Charlotte and Nashville and Phoenix, and a lot of those kind of high growth, more secondary markets that have 10, 20, 30, 40, 50 years of runway to go, right? Where incomes and median incomes are still low relative to the big gateway markets like New York and LA, where the cost of living still lower relatively, where you're seeing a lot of population and net migration. Business friendly states also are a big one. I think 40% of the capital that comes into Salt Lake specifically, is coming from California, where they want to be in a more stable, business-friendly tax environment, right? And so I think that market selection is one of the major things to focus on. And what you all can do is you're experts in your market, right? A lot of what you guys put in your materials, right, I'm sure are very similar to what we do as well, and talking about public and private investment in the state and what's happening in the neighborhood and what's going on in kind of the macro level on in each of your markets. And I think that translates directly to commercial real estate. So let's dive in on how to value commercial property. And I struggled on this one. I told Brooke, I said, we got to keep it high level. I don't want everyone falling asleep on me here. But I do think that there are some simple ways to get you guys, some data and some understanding to make you just dangerous enough, and kind of know what you're talking about as it relates to how to value commercial real estate. So the foundation that you really need to understand is net net operating income. This is the driver of all value. And it is very simply your income, right? All of your income, and that can come from a few different things. And let's just use multifamily as an example, right? And let's go smaller. Let's just say we have a duplex, right? And we charge the tenant rent, but they also pay for the utilities. Maybe they pay a fee to park, right? Maybe they, have some other income on there additional to rent that they're paying, that gets rolled up into the total kind of gross operating income side. Then we're going to look at our expense side of the aisle, and we're going to say, okay, what are the expenses that I have on a regular kind of recurring basis, right? That's going to be taxes, insurance, maintenance, property management if you're not going to self-manage it yourself, and they can take up to 10% of gross revenue, right? But I want to be clear, what this expenses does not include is the debt service, right? The debt service is below the line, below the NOI line, right? Because debt is variable and debt is dependent upon your buying power, right? A lender might be willing to give Joe Schmo, a 70% loan on this duplex because they have a track record and they've got units and they're high net worth and they've got other assets, right? Versus Sally over here is her first property, right? And so, so they might not be giving her as much leverage or a higher interest rate. And so we eliminate that from the expenses because it is dependent upon moment in time and the borrower, right? So very simply, your net operating income is your income minus your operating expenses to get to that number, at which point we would apply a cap rate, right? And the simplest way that I can explain cap rate, and let's just take debt out of the equation, right? So don't even think about that, is if you had a $1 million net operating income, and let's just say the market was okay earning a 5% return on that income annually, right? The way that you do this valuation would be you would take that 1 million NOI divided by 5%. So it's an inverse relationship, and that gets you a $20 million property valuation, right? And so let's put it into some of the conversations you guys might be having when you're talking to groups that want to get in commercial or investors. I think, and for example, let's just take Nicole's clients for a second on the senior housing. If I were in Nicole's shoes, I would ask them, okay, what kind of return would you look for annually, right? And they might say, you can just ask them point blank, what cap rate are you comfortable going in at? And they might say, let's just take that example, right? They'll say, yeah, we're okay at a 5% year one going in cap rate. Very simply, Nicole will just take the NOI from the senior housing asset that she's working on, divided by 5%, and that's the value that her investor would be willing to pay for that asset. Cap rate is really dictated as a metric of risk, right? Because if we're going to put our dollars up and we're going to invest in something, we're only going to be okay with a lower return if we feel like there's not a lot of risk, right? And so I think a lot of commercial real estate does go off of the 10-year treasury or the 5-year treasury, whatever your hold period is going to be, because that is the least risky investment you can make. And so if, for example, the treasury is at a 4% return right now, what is the spread above the treasury that you would want to get for taking the risk on for commercial real estate, right? Because there's a lot more that can go wrong and not go your way, and is outside of your control in commercial. So you want to have some spread there to account for that risk adjustment. And so the lower the cap rate, the safer, the less risky that investor or the market views that asset class, that investment. The higher, the more risky, the less favorable, right? So I'm going to pause there. Any questions on kind of high level commercial valuation? Pretty straightforward,
So when you're working with investors, are they looking to be 4 or 5 cap, or I mean, I know some investors are like, this is a 9 cap. It's amazing. I haven't seen anything like this in a long time. And I'm like, so confused, does
Yeah.
that question make sense?
Yeah, no, 100%. I think that, it's funny, you do hear that a lot. And when I'm talking to, some younger investors in the market and they're saying, "Oh, hey, Michael, like what do you think about this deal? It's a 9 cap rate, right? That's such a good return." But, it's a 9 cap rate for a reason, right? You're taking on a lot of risk, and I think that that risk is underestimated in a lot of cases, especially with new investors in commercial real estate. So, yes, I think that that resonates with me, Heather, because we deal with that all the time with younger folks or unsophisticated investors coming in and asking our opinion. And it really is that education of, hey, yes, the return is good, but also you're buying at a 9% cap rate. What if that tenant moves out and breaks the lease, right? Because they're not credit and their financials are a little shaky. Now, what's 9% of zero? Zero, right? So you gotta understand the risk adjustment in cap rates, absolutely. And that can be by asset class, but it can also be by market, right? So you might have 100% occupied office deal with credit tenancy, but it's in, Cedar City or in, maybe a lower demographic, lower growth market. Well, that cap rate isn't going to be the same as if it was in downtown Salt Lake or downtown Louisville or whatever it may be, right? So it can be risk adjustment on the income, but it can also be on the location, right? And I think that's a good segue into uh, actually here really quickly. I'll touch on this. We've kind of talked about it. Um, Comparable sales for us as we kind of going further into the valuation side of it, we still use it, right? But it's really used to see, okay, what is office trading at from a cap rate perspective in general, right? We're not really looking at the total dollar amount or the price per foot per se, or any of those things. Comps are really used to try to get comfort that, I'm not buying an office that the rest of the market thinks, is trading at a 10 cap. I'm not buying it for a 7, right? If I thought it was a 7 and the market thinks it's a 9, well, why am I viewing it less risky than the rest of the market? So it's a good gut check for investors. Replacement cost is another big one that we use, right? So if you're looking at a multifamily building, and you've got your cap rate, and maybe the cap rate for the client that wants $1 million for their duplex, the cap rate's way lower than where the comps are showing. The other argument that we make a lot of the times is, well, look at the per unit price, right? What would it cost to replace that today? And with inflation and tariffs and everything else, this is a big argument right now for what I'm doing in multifamily. So I'll tell you a real life example. I'm bringing out a $210 million multifamily deal in downtown Salt Lake City. That's a big check for anybody in the country and for Salt Lake City, right? I mean, we're still a small market as it relates to commercial. And so, one of the arguments that I'm making is I'm trying to get very aggressive pricing. That'd be $500,000 per unit on a 422 unit deal. We have not seen a comp in the market at 500,000 per unit. My argument, and our cap rate on that one's going to be 4.5%, which is like right where treasuries are trading. So there's not a ton of risk spread there. But my argument is, because of tariffs, because of construction costs and the inflationary pressures on them, because of labor and everything else, it would cost an investor or developer 200 million, 500,000 a door today if they were going to go and build and do that. And we are eliminating construction cost risk, interest rate risk. We're eliminating lease up risk. So the time it takes from when you deliver to get to 90-95% occupancy across the asset, all of those risks are taken off the table. So you're buying this asset stabilized, so 100% occupied with that income stream already there at replacement costs, right? And that's a really strong argument in today's market. And then going in, and we kind of talked about these, but cash on cash is what's the percent that they earn on the invested equity, right? So for example, let's just say 50% loan on a $100 million deal means you need 50 million in equity, and that NOI divided by that equity amount is that cash on cash return, right? So it doesn't take into account the return you get when you sell the project or anything else. It's just simply what is my cash return on the equity in the deal. IRR accounts for the time to growth, the exit. So they're going to account for cash on cash, but they're also in that kind of annual cash flow you're getting, but they're also going to look at rent growth, right? Expense growth as well. And then they're going to model, what do we think in year 5 we can sell it for? And then we run discount cash flows that then give us those returns over time. The market really likes to see, depending on the asset, call it 12 to 20% internal rates of return. And then equity multiple. That's how many times, right? 2x. And a lot of times you hear this in residential flips and things like that. How many times over do they get their money back? Very simple metric, but still one that is widely used. I thought it'd be interesting to talk about a real life comparison, kind of deal comparison. These are 2 offices that I've sold in the past 6 months. The one on the left is the New Park office up in Park City in Kimball Junction. Park City, if you don't know, I mean, very desirable location. This has a bus stop, that takes you 5 minutes to every ski lift, Deer Valley, all the major resorts, Park City, right out the front door. It's right there in Kimball Junction. Mountain views, just spectacular area, right? Vivint headquarters. Vivint is a credit tenant, and they have a headquarter building in a market in Salt Lake called Lehigh, but very similar buildings, right? One's 125,000 square foot office, one's 150,000, one's multi-tenant, right? So a little different. One's single tenant. The multi-tenant, New Park, was 95% occupied. Vivint was 100% occupied, and they both had about the same lease term remaining, right? So as an investor, you have confidence in that cash flow for about 3.5 years, and then from there, you got to either release it or renew your tenant, right? Any ideas or guesses, and maybe Heather, I'll put you on the spot on this one since you know Salt Lake. Any guesses at which one sold for more?
Oof. I mean, Park City is more expensive, so my brain logically says Park City, but Vivint having a single tenant in there, and
And
that
credit,
tenant is
right?
absolutely positively not going to leave that building, because I know Vivint, they're just not going to leave the building. So I feel like, I mean, you have to constantly be releasing on the New Park, but Vivint's not going anywhere. So I feel like Vivint should be the better deal, but Park City's more expensive. So that's
Ready?
okay.
New Park sold for $300 a foot and a 7.5 cap. Vivint
Crazy.
sold for 125 a foot and a 12% cap rate. These deals, and Heather, I put you on the spot, but in in a normalized office market, you would have been absolutely correct. But I wanted to show this because this is how quickly commercial real estate can change, right? And so 3 years ago, Vivint, with the credit, the location, the quality of the building, it's a newer vintage building. Vivint's a massive company here, and so you would have thought that, I think 3 years ago I would have sold Vivint for well over 300 a foot, right?
Mhm.
But now, because office and work from home has really changed the dynamics of how investors view office, they're looking at New Park and they're saying, we have 95% occupancy, and if we lose one tenant, it's not going to kill us, right? Like, we can release a 5,000 or a 10,000 square foot space pretty easily. And it's still Park City. So the underlying land value, if office never came back, is going to be much greater than anything, in Salt Lake County or in Utah County. Versus Vivint, they're saying, well, they were just acquired. by a private equity company. So we don't know what that company is going to do with it. We only have 3 years of term left on the lease. And because they were just acquired, we don't know if Vivint's going to stay or not. We don't have confidence. They're telling us that they are, but there's nothing in writing. There's no deal. So we can't bank on that. And if Vivint were to leave, the cost for us to re-tenant that building is going to cost us 125, 150, $200 a foot. And so if that were to happen, we need to account for that risk. And so we need to buy it at a per square foot price that gives us spread there and at a return that is risk adjusted for the risk that we're taking on.
See, I should have known that because I didn't think about the whole building being occupied by Vivint only, where like I rent out individual offices and they rent really easy because they'll always be easy to rent. So
Yep.
I failed. F.
It was kind of a trick question, though. I put you on the spot, but I think it is. It's really a point to show that, you know, every single office deal is different. Every single deal in commercial is different, right? And the story and understanding how investors think, and that changes, that shifts, right? Literally every 3 months, I have a call sheet, and what I do is I talk to groups constantly and we track capital and what are the return metrics for all of these asset classes and who has what money and all of those things. It's a big part of what we do. Otherwise, we wouldn't know how to value it. It's just an interesting kind of case study because kind of in the world we're in right now. And I know we're running up on time here, and I really want to get to opportunities for you all. And if I were to kind of put myself in your shoes and try to break into commercial real estate, what would I kind of lean on, or what advice would I give you, right? I think it's just about having enough knowledge to be dangerous, right? And knowing and aligning yourself with commercial brokers in your markets, right? And building those relationships. So understanding the basic terms, right? And we touched on a lot of these: NOI, cap rate, 1031 exchange. I'm sure a lot of you have dealt with that, where, you know, you get to avoid capital gains by, you know, investing your if you sell an asset, you know, investing those returns into another commercial property within, you know, a set period of time. There's a lot of that happens, and you know, I think that's a big driver of commercial real estate and investor sentiment. And then, for example, you know, understanding the lease terms, right? For retail, a lot of times it's triple net leases. What that means is the tenant's responsible for everything. As a landlord, you don't have to do anything. The roof leaks, not on me, it's on the tenant, right? And so triple net leases are great. I love triple net. If I could, you know, I'm working on, I'd love to buy more of that unanchored strip retail. And I like that because none of the expense loads on me. And so it's just the income. And if anything were to happen, it's on the tenant. That's a great investment in real estate, right? When you can eliminate the expense side of the aisle to a certain degree. Market drivers, just understanding where interest rates are and how commercial real estate interest rates, you know, are priced. It's not off of, you know, prime or whatever, right? It's off of the treasury, right? And so they'll say, you know, a lot of commercial lenders will look at if it's going to be a 10-year note, they're going to look at the 10-year treasury, and those lenders have spread and risk adjustment. For office, right? The spread over the treasury is going to be, you know, maybe 300, 400, 500 basis points, right? For multifamily, 100, right? And so understanding how that works and you know, the different lenders and in the market, I think is a great way to add value in just discussions with clients. Understanding the supply demand in your market, super easy to do. What apartments are being built right now and who's building them? Is any office going up or not? How about retail, right? So just understanding, where should you build, right? Where are the nicest neighborhoods? Where are the highest demographic areas? If you ever get in and have a relationship with a retail developer, those are the kinds of questions that you're gonna they're gonna ask you. And as a residential agent, I think you guys have more of that understanding of who's living where are the higher demographic areas, the nicest schools, the most traffic, all of those things. I think you guys are well positioned to be able to give a ton of insight on that in your respective markets, as well as the demographics, right? And I want to talk about really quickly just some common pitfalls of commercial real estate, right? And things that maybe if you didn't know, you wouldn't be thinking about. But on land, what are the zoning challenges? Is the city going to approve this, right? And understanding what the zoning and the code and ordinance allows for. And, if you get linked up with the developer, telling them like, hey, I know this municipality, right? Maybe someone on the planning commission board or whatever, and they are very pro development. You should talk to them, right? That kind of connector for commercial real estate developers or investors to connect them with your relationships. I'm sure you already have in your markets goes a very long way in building that trust. Understanding, tenant risk, Heather just said, hey, I know Vivint really well, right? Like there you go. That's exactly it. And so you could touch on that. You guys are plugged into your communities. You've probably sold homes for CEOs and business founders, right? I think you use that knowledge. I think the other things to think about that I think might be a little different are, we don't have a standard rep C or contract. Attorneys do all of the contract work. And so getting plugged in with a commercial real estate attorney in your market and be able to give them referral business, I think is huge. I like to say attorneys kill all deals. That is true. I've had 5 deals this year get killed by attorneys, and so it's challenging when you've got a lot of attorneys sending comments back and forth on a contract. And I think, just to kind of sum that up on the pitfalls, you can't time the market, right? Every asset class has its day. Retail, I think was really struggling, during COVID. Now it's doing great. Office was fantastic pre-COVID. Now it's not, right? And so you can't time it. You never know when there's going to be a pandemic or something outside of your control. And that's why, there's a lot of inherent risk in commercial real estate. And then finally, I think spotting deals, right? Recognizing when a residential client may have commercial real estate interest or a need. Maybe they own a business, right? And they want to expand. Maybe they just had sold the duplex. Great. Well, are you going to 1031 that? And can we help you find your next property? Things like that. Inherited land or wealth is another big one, right? So maybe you have a high net worth client who, just passed away, and now the kids are owners of an estate, helping them with positioning those assets, and building the wealth, right? And then, I think networking value, right? So adding value, knowing enough to introduce to the right CRE broker, lender, or investor. I call it the connector. And it's a great way to establish yourself as somebody who plays in the business without having to know it a whole lot. And you connect enough people, that's going to come back. If I were in your shoes, I'd start with multifamily, right? It's the most likely or the most alike to what you do. And so a great entryway in is, call it 2 to 4 unit properties. I think that's a great way to kind of dip your toe into commercial real estate. And then finally, referrals. And I do this all the time with residential agents is I like to say, get paid while you learn, right? And so the fees are much bigger on commercial real estate because the dollar amounts are much bigger, right? And so if I had $100,000 commission or a $500,000 commission, right, in a lot of instances, and maybe it's outside of your realm or what you can do. Well, if you were to bring it to me and say, hey, Michael, I got this opportunity, I don't really know how to tackle it, but I'd love to learn. I'm gonna say, great, give it to me. I'm going to let you be on the deal the whole way through, see everything that we do, be on all the calls from start to finish, and I'll give you 20% of the deal, right? And you don't have to do anything, and you can learn kind of what we do and how we approach it. And I've done that, I think, with well over 10 residential agents, and one of them was a big, $500,000 commission they earned 20% on. That's a good day, right? And at the same time, they were able to learn about what it takes, what to do, the questions the client was asking, and I think it can be beneficial to everybody. That would be the one I'd point to start, right? Align yourself with a broker in your market, build a relationship, start sending some referrals, and just be along for the ride. And there's no replacement to that experience. And then, yeah, I think just to sum up here, the reality of CRE, steep learning curve, longer relationship building timeline. I think that's kind of core to just trying to get into the business. Number two is you compete on everything, right? It's that relationship gets you in the door, but I think I've pitched on, $1 billion worth of product, where it's like I've been working these relationships for the past 2 years. You'd think that they would just say, yeah, here you go, here's the deal. Nope, still got to go and give the pitch because they have other investors that don't know me in the deal. They have other people involved that have a say. So nothing's ever given, everything's earned. And then finally, I think there's so many different ways that you can add value, as we talked about in commercial real estate, to help get your foot in the door. It's just about recognizing where you can find and add that value and taking advantage of those moments, right? Being the connector, high net worth clients, estate planning, smaller duplexes, right? So many different ways to get in. It's about recognizing those opportunities. So, and with that's all I got for you guys.
And you just work in Utah.
Just in Utah.
Okay. That was amazing. I learned a lot. Does anybody
Good.
have any questions?
Yeah, any questions?
Do you
No,
think
thanks
it's
so much, Michael. Appreciate it.
Absolutely.
Michael? Do you think it's normal that if when we call on a commercial that the commercial agent on the other side might like ask us certain questions to make sure that we know some of those terms that you were talking about? Like they almost test us out to see if they're dealing with a residential agent or if they actually are dealing with someone that they know what's going on.
Yeah, yeah. I mean, we do, but I would say it's not so much about the agent itself, right? Or him or her. It's more about vetting out the client, right? And I think that's where, as like when I get a call from a residential agent, I'm not thinking, oh, they don't know what they're talking about or they don't know what they're doing. I think more about, well, did they vet out their client appropriately? Do they have the funds in hand to be able to do this? What kind of lending and kind of debt structure is the client, targeting, and have they explored that? Really more about the feasibility of your client's ability to close, not so much about, the qualifications or the knowledge base of the residential agent, right? And I just think that comes from not knowing how we do things. Like when I list a project, we have 5 bidders, right? I'm asking those questions because I got to go to the client and say, this is the group and they are going to close and here's why. I know how they underwrote it. I know they have their debt lined up. I know they have the cash on hand. They provided proof of funds, blah, blah, blah. Those are the things we're vetting out.
Very helpful.
Yeah, great question.
Any more questions?
Anything else? And Heather, please feel free to and I do only work in Utah. That said, we have clients that do deals all over the country. I might not know your markets specific, but what I can do is I'm plugged in with Cushman and Wakefield capital markets across the country. We have standing calls monthly with my lead kind of counterparts in other markets. And what I'd be happy to do is for your respective markets, give you kind of a warm kind of lead into developing a relationship with your local investment sale broker at Cushman, because I likely know them and can put you into contact there. So happy to do that. And then also, doing all asset classes and really competing nationally here. We can help you guys if you have questions on specific deals you're working on, opportunities in your market. So please feel free to reach out to me individually if anything like that comes up.
Awesome, Michael. Thank you. That was such great information. I definitely understand, especially the cap rate side of things, a whole lot better. So
Good.
thanks for taking an hour out of your time, Michael, and everybody else. And if anybody needs anything that we can help you with, reach out. And until next month.
Thanks, everybody.
Thank you.
Thanks.
Thanks, Heather.
Bye.